My name is Solange Charas. I'm the CEO and founder of an organization called HC Moneyball, where we work with clients to help them understand the material impact, efficiency, and effectiveness of their human capital programs. I'm also an adjunct professor at 4 universities: Columbia, NYU, USC, and University of Washington. And I'm on the ISO TC 260 committee, working right now on the redesign of the ISO 3414 standard. And what we at HC Moneyball are trying to do is enhance decision-making through data analytics. So I'm a data wonk. So welcome, everybody. And I'm co-leading with Rebecca Fernandez. So Rebecca.
Hi, thank you, Solange. Hi, everyone. I'm very happy to be here today to be talking about a very important topic. So my name is Rebecca Fernandez. I'm the CEO and co-founder of Aware app. Aware is a data-driven employee listening tool in which we help organizations to assess, analyze the sustainability impacts on people. So in short, we are a quality soft data platform that we help organizations to measure insights through impacts on or any kind of insights of people, engagement and sentiments or work-life balance and so on. I'm also a ISO 30414, which stands for Human Capital, for an international standard in human resources management guidelines for reporting, for internal and external reporting capital. And I also part of the international committee as Solange, and I like to define myself as bridging the gap between business, technology, processes, and people data. And as mentioned today, Solange and I, we are going to be discussing about what we think is a very important topic, which is related to the European Sustainability Reporting Standards, or ESRS, and especially in the size of the world where I'm today, which is, well, I'm in the UK, but it's more European part of the world. As you can see from the slides, today's agenda, we are going to be covering a few topics. So how we did get here, why we should care, what is ESRS reporting? We will give a very general overview. We are going to be focusing on today's talk in S1, and we are going to explain what that means. We are going to be also covering who needs to comply and by when. How does it fit with other HR reporting frameworks? What do companies need to do to comply, and what next? And of course, we are going to leave some minutes at the end for a Q&A. And if anyone do have any questions, please use the chat, and we are going to pick up your questions at the end of the session. So over to you, Solange.
So I just wanted to give a brief history of how we got here, because a lot of people think that human capital reporting is sort of just sprung up after a good rain like a mushroom. And that's actually not the case. So I wanted just to put together a quick, brief history. It's actually human capital reporting and human capital impact has been studied in the academic literature for probably 30 years. I didn't want to go back that far. I just put a little, stake in the ground in 2015 when the UN SDGs were released. And the next important milestone is in 2017 when the Human Capital Management Coalition wrote a letter to the SEC saying that they want to see more disclosure around human capital management and human capital impact, because that's core to the way organizations create value. And I am very honored that Meredith Miller is in the room, and she is one of the founding members of the HCMC, and in fact, the signer of that letter that was sent to the SEC. So thank you, Meredith, for being in the room. I'm extremely honored. there have been, thank you, Meredith. She just turned on her camera and you're on mute, so I can't hear you.
Oh, thank you so much. I'm really delighted to be here, and thank you for recognizing the work of the coalition.
It's a milestone event, really.
Thank you.
Then you can see BlackRock took a stand in considering human capital as part of the ESG factors in corporate strategy and corporate performance. Then the Business Roundtable came out with their stakeholder statement in 2019 with the World Economic Forum. Then in 2020, we have the SEC that comes on board. And probably the most important thing that happened in 2020 with the SEC is the redefinition of human capital. And the SEC, I want to just have another shout out to the HCMC. The SEC was really informed by the work of the Human Capital Management Coalition. And what the SEC did was, and there's lots of moving parts, but the top line summary is the SEC redefined human capital not simply as an expense to the organization, but as an investment in an intangible asset. And when the SEC reframed human capital that way, it really created a shift. The shift has happened, but the compliance and activity that reflects that shift, we're just beginning to see now. So, and this is what I teach my students. So this is really a milestone or a watershed event, is this redefinition of human capital as an investment in an intangible asset. Then the Corporate Sustainability Reporting Directive came out. Then IFRS, the International Financial Reporting Standards, talked about human capital as part of the new global sustainability standards. And here we are looking at EFRAG and the ESRS reporting standards, which is what we're going to be covering today. So this didn't just come out of the blue. There is a history behind it, and there is momentum. So we're really excited about that. So why should we care about a new framework? Well, I think the new framework really distinguishes this expense versus investment orientation. So in the past, human capital was thought of as an expense. And the way companies managed higher levels of profitability was basically cutting human capital and human resources. That was the fastest pathway, because for most organizations, human capital cost is often 50% or more of their total operating expense. So when a CEO said, let's push profit, the CFO said, oh, well, our biggest expense is around people. Let's cut those people costs. And they weren't wrong, because it does generate higher levels of profitability in the short term. And guess what? They actually got positive reinforcement for that, because Wall Street would react to cutting headcount and cutting staff costs by actually favoring the company. So investors were saying, oh, they're cutting their expense, so let's buy their stock, right? So companies like Verizon, and I hope nobody from Verizon is here, would use this as a strategy to boost their share price. They would cut heads, they would do a staff reduction, the stock price would go up, and then they'd re-add that staff back slowly. So they actually used it as a strategy to enhance their share price and therefore their market capitalization. But that is not sustainable. So we need to look at the future orientation, or the future approach, bolstered by the SEC and by EFRAG and by the World Economic Forum and by UN SDG and by all these other frameworks that basically say human capital is actually a pathway to generating value in the organization. And therefore, we need to invest in human capital. And what I tell my students, which is an analogy that I think is easy for them to understand, is if you think of human capital, of people and workers as gasoline in a car that's going to take you to your destination, if you cut the people out of the organization or you drain the car of gasoline, don't be surprised when it's not getting you to your destination. So with this future orientation of human capital being an investment in an intangible asset to drive sustainable value creation for stakeholders, we need a new vocabulary to talk about that. And, you know, the new vocabulary includes metrics that reflect that investment idea, which is human capital return on investment, HCROI, human capital value add, HCVA, human capital investment intensity, which is the percent of operating expense going to human capital, so we can actually understand the ratio of investment in people versus other operating items, productivity per employee, and then these other measures of human capital productivity like expense ratio and productivity ratio, and other measures that are embedded in the ESRS and the ISO standards. And the ISO standard, the 3414, we're actually redesigning it to have all the expense or the cost items together, so they're not disaggregated across the whole standard. We're going to bring them all together into one space. And as I said before, there's an abundance of research that proves out the relationship between effective human capital management and higher levels of corporate financial performance. People are your engine of economic value creation. And also intuition tells you that, right? How many years have we heard CEOs say employees are our greatest asset, but they don't show up anyplace? So now it's time for them to show up. What we want to do now that we've created a context, is talk a little bit about the ESRS reporting in general, and then drill down into ESRS S1, own workforce, which is the standard that really covers the human capital side of it. And I'm going to send it back over to Rebecca.
Thank you. I don't know if everyone is in the room, but I'm a person, I don't really like acronyms. And ESRS, as mentioned previously when I was describing the agenda, stands for European Sustainability Reporting Standards. And they are standards, as Solange has mentioned, related to environment, social, and G for governance. As you can see in the picture below, under the social banner, there are 4 standards that set out required disclosure related to internal rules and policies. And as you can see, they do have more acronyms. That means the subtopic, which is S1, S2, S3, and S4, in which S1, as Solange mentioned, which is the scope of our today's presentation, is on workforce, and S2, workers in the value chain, are cross-cutting standards. That means that they apply to all sustainability matters. And then we have S3, affected communities, or S4, consumers and end users, that are topical standards, that they mean that they apply to specific sustainability topics. Thank you. In this slide, I'm not going to just read everything, because that's not the purpose. I'm just going to focus in what is the scope of today, as mentioned, because we are going to, of course, share the presentation after the session. So as you can see, ESRS S1, as mentioned, is the own workforce, and it's mentioned it focuses and covers information about the organization's workforce, and includes size, composition, and diversity. It's also worth to mention that according to the standard, own workforce means that they include both employment relationships, so employees and non-employees that are self-employed workers, or non-employees which are by undertaking primary engaged in employment activities. So that means individual contractor or agency workers, also including own workforce. The standard also requires organizations to disclose information about their policies and practices on human rights, such as their policies on child labor and forced labor. And as mentioned, we have S2, which is workers in the value chain. The standard applies to all workers who are employed by the organization. That means upstream or downstream value chain firms, and it's expected that they are expected to play a major role in improving the transparency of organizations, supply chain, and in ensuring that workers in the value chain are treated fairly. And then, as mentioned, we have S3, which is affected communities, and S4, which is consumer and end users, but they are topical standards. So I'm just not going to describe them because they are not the scope of the presentation.
Okay, so
and over to you.
Yeah.
Yes.
So let's drill into ESRS S1 a little bit. And forgive me if I'm looking from side to side. I actually work on 3 monitors, so I'm not trying to be squirrely. It's just that I'm looking at my notes on one and making sure that you see the slides on the other. So hopefully that doesn't come off as being not squirrely or untrustworthy. That's just how my system is set up. So ESRS S1, again, is about own workforce. It's a draft at this moment. It hasn't yet been passed. What it does is it provides guidance on how organizations should disclose information about their own workforce. Again, S2 really talks about upstream and downstream, working with suppliers and vendors and their workforces. And the idea behind that is we want to make sure that companies are working with other organizations that also comply with the standards, that treat their people fairly. When we send out the slides, we've embedded some links. There's an EFRAG video that from somebody at EFRAG that talks about the standard. So we thought that would be interesting. And there's also an HBR, Harvard Business Review article on the standard. We thought that would be interesting for you as well. So we've embedded some resources for you. So the standard, again, provides guidance on our organization should disclose information about their own workforce, and it includes a lot of topics like size, composition of the workforce, policies and practices, human rights, and impact on society. So it's actually covering all the stakeholders, and it's expected to be finalized this year and implemented in 2024, which means that you have the calendar year 2024 to actually create your disclosures against the guidance or consistent with the guidelines that are provided in the standard, and you'll start reporting in 2025. And what companies are always saying to me is, well, that's a long way off, right? So I don't really have to worry about it. But it isn't a long way off. And you need to prepare. You don't want to be caught with your proverbial pants down when it comes time to report and disclose and have a bad story to disclose. You want to know what's going on in your organization today so that you can work on remediating any potential risks that you see, so that when it comes time to report, you're reporting a clean bill of health. So don't wait till the last minute to figure out whether or not you have issues that you need to address in your organization. This is essentially the outline of the standard. So they have an introduction, definitions, materiality, and we're going to talk about materiality in just a minute, but materiality that is really the heart of the standard. The materiality, again, we're going to talk about this in a few slides, but it's really to understand your impact, your organization's impact on stakeholders, and the way, you know, the Business Roundtable has described this stakeholders. And it's really interesting that materiality is now being included in these standards because we've learned our lesson from Sarbanes-Oxley that Rosemary Romano described as quack corporate governance, right? The idea around governance is actually, the spirit of it is to generate good business practices. And what happened with Sarbanes-Oxley is that it turned out to be a check the box exercise. And that's why Rosemary Romano called it quack corporate governance, because it actually just turned into a checklist and it defeated the spirit of governance, of disclosures and governance quality. And so this idea of materiality makes it very difficult to turn these standards into quack governance, because it's not just a tick the box exercise. You really have to discuss and disclose, which is the next area, disclose on your performance in these areas. The next section is about auditing, and it actually lays out how the disclosures are going to be audited. And then the last part of it, which is actually half of the standard. So the standard's about 68 pages long. The appendix is about 30 pages long. So the appendix is really the glossary and the blueprint. So that's how ESRS lays out. And what's a little disappointing for us in this sort of governance monitoring space is that it is still principles based. So the SEC in 2020 came out with a requirement that organizations have to disclose on human capital performance if it is deemed to be material, and we'll talk about that in a second, to the organization, but it was a principles-based approach, which meant that it allowed the organization to determine whether or not human capital was material to the organization. And that allowed sort of a loophole for organizations, public filers, to not disclose anything, or to disclose the bare minimum that might satisfy an investor. Under Gary Gensler, he doesn't like principles-based approaches. He likes rules-based approaches. And what we are anticipating with bated breath for the last year and a half is for the SEC to disclose their guidelines for human capital disclosure rules-based, which means that every filer has to disclose information regardless of whether or not the filer believes it is material. The ESRS is still a principles-based rather than a rules-based standard, which gives organizations the flexibility on how they're going to comply. So this is a little bit of a disappointment. And the other little bit of a disappointment is that the standard does not include formulas on how to calculate values that need to be disclosed. So they're leaving it really up to the companies to figure out how they're going to calculate values and disclose those values. And that is a little bit disappointing because it actually defeats the purpose of comparability. So we don't know whether or not we're comparing apples to apples because different companies may calculate values different ways. And that is exactly what the SEC is trying to avoid, which is, I think, going to be very evident when they release their guidelines for human capital reporting as a rules-based approach. It's aligned with the International Integrated Reporting Framework, the IARC, which is another global framework for sustainability reporting. So that's aligned. And it is designed to be comprehensive. So I guess that is a good thing. Here I said should, shall, could, and must language, right? Which actually are cues to what has to be reported, what is recommended to be reported.
Solan, sorry, is the next slide?
Yeah.
Sorry, it's not. Yeah.
So I just put the standard through ChatGPT and let it do its business. And I asked it to tell me how many times these 4 words appear. And you can see that it is the language tends to allow the filer, the companies that are going to be compliant, a lot of leeway. So the should and the could and the shall, these 3 words, should, shall, and could, are more prevalent than the must, right? Maybe shall could be interpreted as a requirement. So we've got almost 40 shoulds and coulds, which gives you leeway. And we've got 23 shalls and musts. So you can see that the language itself is giving people a lot of leeway in what and how they should report. And I guess that's a little disappointing too, but we'll see what happens when we see what comes out. Over to you, Rebecca, on the materiality.
Thank you. So as Solange just mentioned, there is this double materiality reporting, which is a concept in sustainability reporting that organizations to disclose information that is material to both financial performance and sustainability performance, and relates to financial and impact independently. That, for example, information about an organization's impact on environment or its policies on human rights might be material to its sustainability performance, even if it doesn't not have a direct impact on its financial performance. So this is something important to remind, that is in 2 dimensions: financial impact and financial and impact in sustainability. This is a description what that means. So financial materiality will require disclosure of sustainability related matters that may trigger material financial effects on company development. For example, cash flows, financial position, or financial performance in the short, medium, and long term. And the impact materiality will require disclosure of sustainability-related matters to relate to companies' material, actual or potential negative or positive impacts on people or the environment over the short, medium, or long term. And what are the benefits of ESRS S1 reporting? So it can help organizations to improve their sustainability performance by identifying those areas in which companies can make improvements. Communicate to their sustainability performance to their stakeholders, which it is in reality everyone, such as investors, customers, and employees. Manage the risk and opportunities related to sustainability. As Solange has mentioned, ESRS reporting is not ticking the box exercise. It's really a rich management tool for companies, and also comply with regulations related to sustainability. And
Okay.
over to you.
Thank you. So given that you now understand the concepts around double materiality from a financial perspective and from an impact perspective, a social impact perspective, we thought that we would unpack the actual elements that need to be disclosed according to the standard. And I want to give a shout out to 4C Group, Heiko Moritor, who is a partner in the HR Impact Group, which both Rebecca and I participate in, and also the TC 260 committee. They've been doing, he's been doing a lot of work on ISO standards and ISO certification, especially the 3414 standard, and they are a fantastic partner and a fantastic source. So I invite you to go and check them out. They're in Germany. So if you look at all the dimensions inside of the ESRS S1, both part 1 and part 2, you can then begin to understand what could potentially be covered under financial materiality and under impact materiality. So you can't ignore it, right? So Dodd-Frank, Sarbanes-Oxley, and also Dodd-Frank really ignored social impact. This standard incorporates social impact into the disclosure part. So you can see that it has a lot of elements to it, and it's pretty comprehensive. Okay, so who needs to comply and by when? So,
yes, so it will be the ESRS reporting. It will be mandatory for all public organizations trade on any European exchange with more than 500 employees. This not include private companies or non-profit organizations. However, other reporting frameworks suggest these standards are used to communicate to stakeholders. Public company compliance timeline after passage, which is expected to be, as Solange mentioned, at the end of this year. For large companies within 12 months from January 2024 for reporting in 2025. Medium within 18 months for reporting in mid 2025, and small companies within 24 months for reporting in 2026. Next slide, please. So this is also coming from the 4C group that Solange just mentioned in the previous slides. And it gives us a reporting requirements overview just based on reporting periods, type of company, balance sheet, total net turnover, and the average number of employees, and gives a very nice snapshot of who and when needs to comply and under which basis. So.
And let me just emphasize here that, and in the invitation, I'm not sure that we made it very clear, but this information is not just important for companies that have to comply with the filings. This information is important for investors, right? For all stakeholders, but primarily for investors, because if you believe that human capital is a driver of economic value creation for the organization, you want to invest in companies that are treating their human capital well, that are treating their human capital appropriately as something to invest in, not something like a resource to use up. It's not, it's important information. And again, a shout out to the HCMC for investors to really understand the sustainable contribution of human capital to long-term success of the organization. So as an investor, you should care. At the conference board, we did some research about consumers. And what we found was that 68% of consumers care about human capital treatment. And that sounds like an awfully large number, but consumers are also employees. So I believe that that really is the case, that consumers care about how companies treat their employees, from fair treatment, fair and equitable treatment, pay equity. They care about LGBTQ They care about diversity and inclusion. And those were the top issues that consumers reported that go into their purchase intent. So if I were a CEO and I knew that my consumers cared about how I treated my employees, I would certainly be paying attention to that, and I would certainly be communicating to the consumer about how I treat my employees. So
I would like to add something to that, Solange. Sorry for interrupt you, because you mentioned about investors, but I do like to also emphasize the fact that also employees are part of the stakeholder group, which means that the standard will also report and measure the impact on people. And as we all the time keep saying, employees are the most important asset. So work-life balance, engagement metrics, so any kind of quality data will be also there. And we know that do have also an impact in productivity, efficiency, and bottom line. So it do have also an impact in the business. So I guess it's also important to emphasize the fact that it's for investor, yes, but also for employees, right? And everyone wants to work in an organization that they treat fairly employees, and they also care about the environment as well. So.
You know, Meredith just shared something about GRI and EFRAG. We are really looking at how the ESRS S1 is aligning with other standards. And obviously, because both Rebecca and I are part of ISO and on the working group 7, which is looking at 3414, we wanted to share with you, again, something that 4C has done already. No point in reinventing the wheel when it's already been created. The content overlap between ESRS S1 and the ISO 3414. And again, as I mentioned, we're re-looking at we're updating the 3414, and we are very mindful of the ESRS standard as we are reviewing the 3414 standard. So we'll probably see more of an integration between ISO 3414 and the S1 standard going forward, but they do overlap. So we wanted to share that with you. So what do companies need to do to comply?
Sorry, I'm not sure who is, if we can ask everyone to mute your microphones, please. Thank you very much. So the first thing that you need to do is to assess, of course, if you need to comply. That's the first thing you need to do based on the information we just provide. And then determine what is material, double materiality. Select, and this is a very important one, select appropriate methodology or consultant to undertake analysis and prepare disclosures. Collaborate, this is also a very important one, with others in your organizations, because it's all about stakeholders and it's everyone really, to get buy-in and support, get legal approvals for disclosures, and prepare for assurance phase, documentation, etc.
So what's next?
Yeah. So if you consider working with us, you can contact me to determine the sustainability impact on your human capital program as ESRS. Reporting is not a ticking the box exercise, as mentioned. It's a rich management tool that uses insights about employees and performance on sustainable outcomes.
And as I said before, my focus is really on understanding the financial impact of your human capital programs. And this is particularly important if 50% or more of your operating expense is actually going to people. That can move the needle on financial performance and financial impact, or the financial materiality. So you can see that Rebecca and I together cover both sides of the double materiality, and they need to be integrated. So, understanding sustainability impact and also understanding financial impact. And, this is not an advertisement to sell our services, but this is a complex area and it's hard to do it on your own. So, you have two people that are part of the ISO organization that understand how to look at standards, how to comply with standards, and we really understand the S1 standard. So we're a good resource for you in terms of getting some guidance and some direction and some tricks of the trade, as it were. So we wanted to thank you for joining us today. Please link in to us, and we are ready to take any questions that you may have. Any guesses on the SEC timeline? Oh my God, if I had a crystal ball, I'm not sure if I would waste it on understanding the SEC timelines, or I would look for the next lottery numbers. Your guess is as good as ours. We are, Jeff Higgins, who is also part of the ISO TC 260 and the Human Capital Impact Group, is pretty close to people in the SEC, and he says that it is coming. We hope that it's before the end of the year, but we have no way of knowing. So my best guess would be that it's coming before the end of the year. And one of the reasons why is ESRS, because US companies that meet the criteria that trade on the European exchange will have to comply with ESRS standards. And that's about 10 to 20% of US companies, US public companies, are traded on the European exchange. So it doesn't make sense for 10 to 20% of US companies to be creating these kinds of disclosures, and the rest of the US filers are not required to disclose. So I think that the SEC has a lot of pressure now to disclose their guidelines for human capital disclosures. Let's see.
So there is a question from Jean Letourneau. Sorry for my pronunciation. Just curious here, what is the explicit value creation part? Just managing risk is avoiding value destruction.
Yeah, so Jean, thank you for your question. I said earlier in the presentation that a new investment approach to human capital creates a new vocabulary, and we can actually measure human capital value creation through some of these metrics. And the metrics are standard metrics. Some of the definitions, some of those metrics, they're defined in the ISO standard, the ISO 3414 standard. Some of the metrics have algorithms or formulas that have been proven out in academic literature. But it is a way of understanding the return on investment in human capital and human capital value contribution. So HCROI is return on investment, HCVA is human capital value add. There are other metrics that I didn't list. There are like 20 different metrics that you can use to understand human capital impact on the organization. If you're a public company, you can actually calculate the human capital market value. You can calculate the human economic value add, HEVA. So there are lots of ways of understanding human capital contribution to enterprise sustainable performance. And if you want a resource, just write to me and I'll send you a couple of academic articles if you're so inclined, or I'll just send you, sort of a definition and algorithm map for all of these calculations.
Yeah, we have another question for Vilma. Thank you very much for your question. Any suggestion on how to do materiality assessment for own workforce? So from my perspective, I will say that to establish your reporting processes will be one of the most and crucial parts. So the reporting methodology. And as we just covered, there are some standards like the ISO 30414 that could help in order to do so. So that could be one way to approach it. And also, yes, to get some external or guidance in order to how to tackle the process. And also the crucial part is also to engage with your stakeholders within your organization. As mentioned, could be everyone in your organization, stakeholders that could be your buy-in and could be your support during the process. That's also important part of it.
We have a question from Jessica. And I'm looking at this question and I don't know how to answer it. It says, so all of the companies under SFDR will also be under ESRS. I'm sorry, what is SFDR?
Sure. No. And maybe just easier to say companies who are under any EU regulatory mandates, SFDR or the taxonomy or any of the ESG regulations that American companies or US based companies who do any kind of business in the EU, they all have to comply with certain EU regulatory things. SFDR is just kind of one of them, probably most relevant to my industry. But and I'm curious, will the ESRS be the same for those companies? Is it kind of like the same grouping of regulations?
I'm not a technical expert, so I'm showing now the 4C group that talks about the requirements. So if the first is, if you're a US company, are you traded on any European exchange? So if you trade any equity on the European exchanges and you meet these two of the three criteria, your balance sheet, your net turnover, or your number of employees, you will be required to comply with the ESRS standards, and not just the S1 standard, not just the S standards, but the E and the G standards as well. So the whole Megillah, you're going to have to comply with that.
On this sheet here, the balance sheet and the number of employees, that is not just their EU-based subsidiaries or branches, that is their global net. Okay.
Exactly right. The global. Let's see.
Rebecca,
Go ahead.
Yeah, can you provide the list of the 20 companies that you mentioned in Europe? Yeah, we can provide that list after the call. Rebecca, thank you for your question. We will provide those lists as well.
Let's see.
Merit Miley.
Jessica, are you a financial institution? You're on mute.
Couldn't find the mute button.
Yeah.
Yes, I work in financial research and data.
Yeah. So Meredith says it will apply. And
thanks, Meredith.
Meredith is an expert, so we'll defer to her. Okay. Any other questions? Hi, Amy. Amy, you can turn on your camera. Where are you? I don't see your camera's not on. There she is. Amy is also part of the TC 260 and part of the HR Impact Group. So why don't you,
And I'm also up in Montreal this week.
She's also
working with TC 260 and the new human capital metrics. And we're going to be digging into new metrics today and looking at some of the issues related to human capital as an investment. So very exciting to be up here. It's just a phenomenal group of global experts in human capital. And it really makes you think that you've got to think outside the box and not just US and SEC standards. But I think my question really was about why is the US has been so slow to adopt human capital standards? So I'd love it if both of you would address that question.
Was this an easy tee shot here?
Yeah.
Well, I think that US companies have been slow to adopt any standards because they haven't had to. And historically, companies have thought about human capital as a trade secret. And that isn't because, they decided to. It's historically been the sort of the law, the old law back, Glass-Steagall, and it's the Taft-Hartley Act. Basically, it prevented employees from sharing any information about their salaries, communicating about that, and companies have really thought about human capital, employees as a trade secret, how much we pay people, how we treat them, how much we invest in training and development, and a trade secret becomes a competitive advantage. So this area has basically been cloaked in secrecy for so many decades that it's just part of the gestalt of running a company, is that you simply don't share this kind of information. And I think that the world is different now, right? There's much more transparency, there's much more social awareness, environmental awareness, and thanks to the Business Roundtable, we've now moved away from a shareholder primacy approach to a stakeholder approach. I see Bruce in the room. Bruce Bolger's in the room, so he's our stakeholder capitalism guy. And I think that the world has changed, and the demands by the other stakeholders for information is really, really important. The SEC is really going to play a huge part in this, because one of the things that we believe the SEC is going to require is an aggregated representation of cost of workforce. So right now, companies have the ability to disaggregate their human capital cost. They put some in cost of goods, and some in marketing, and some in research and development. So they break apart this line item, this budget of human capital, and allocate it to different activities in the organization. And the SEC is going to require an aggregated line item entry that is auditable. So that raises it to a whole other standard, where we're going to see a whole lot of transparency about how much companies spend on human capital. And once that happens, we're gonna be able, it's like putting a company through an MRI machine. Right now, we can only see what's on the outside. Pretty soon, we're gonna be able to see what's on the inside. And I think that once that transparency happens, there's gonna be a whole lot of compliance with standards. So thank you for asking the question. Did I answer it okay?
Yeah, sure. But I think, at the bottom line is we're seeing a very significant shift from compliance and risk management to value creation, business opportunity, growth, and innovation. And companies just have to get their act together to be able to tell their story, to sell to all of their stakeholders, not just their investors.
Yeah. And I also think that managing human capital effectively is a risk management issue. It's not different. It is risk management. When you spend more than 50% on human capital, that moves the needle. How well you manage that human capital moves the needle. One of the things that CFOs are now beginning to recognize is the cost of attrition. It's not, CFOs used to think, oh, attrition is good, right? We lose people, we save that budget. We save that comp cost, right? But now they're beginning to see that attrition is really costly to an organization, it's not saving money, it's not avoiding a cost, it's actually generating a higher cost. And now people are beginning to realize, I actually heard a student say this, it's more expensive to replace an employee than to keep one. And I think that once we begin to see that, we will become more employee-centric as organizations. So, great. Anybody else? We're a few minutes. Here's a good question from Jean. Are humans really a capital? Humans are, according to the SEC, an intangible asset. You can't own a human, right? Those days are over, thankfully. But humans are a driver of value creation. And we think of humans as an expense right now, right? They're a sunk cost, but they're not. They are the engine of economic value creation, especially for companies that are service providers, service oriented. So if you think about the US economy, like 80 something, more than 80% of our economy is driven by services. And you cannot deliver services without people. Now, I know AI and Gen AI is coming, but we still need humans. And in fact, McKinsey and the World Economic Forum are saying that AI and generative AI are going to be job creators, not job killers. And Stella Lepouchore and I, who co-authored our book, Humanizing Human Capital, just wrote a blog post about where we reference the research that McKinsey and the World Economic Forum did on job creation. And I'll put in the chat our website where you can go and access our newsletter and the blog that we just wrote about it. It's really, really interesting. And in the United States, we did some analysis. If you're worried about not being able to find employees now, hold on to your hats. We're going to have something like 57 million deficit in workers in the United States in the next 5 years. It's frightening, right? Right now, we only have 11 million people unemployed. We're going to have 57 million open jobs in the next 5 years and no people to take those jobs. So it's gonna require a shift in your thinking and in your mentality.
Just one note, if you guys still have time. I live in the UK. I've been doing HR in the corporates, mostly British organizations. Someone has mentioned that the US is very late to respond. I'm afraid to say that UK is even worse, because at least in US you have this Security Commissions exchange requirement to report human capital. If I'm not mistaken, it was like that for the last 2 years.
2 years.
Is
Actually,
it? Yeah. 3 years. Okay. So what I'm seeing happening in the UK, believe it or not, I'm not trying to exaggerate, but I would reconsider whether it is a safe place to work now, because the CIPD was clear. The CIPD was clear in terms of how HR became corrupt with managers. So that's going to be challenging, because recently I was talking to one stakeholder. He said, well, actually HR is going to be a big block, to bring that through, because they have their issues, happening there. And the question went, he said, well, but do they really want, change? Because they were comfortably sat. And, and CEO was always fed with the fact that, everything is good, and they created their communities of the corruption. Let's call it as it is. So for me, of course, it's going to collapse. It's a bubble approach, obviously. But I think that US will be in a better economic position because there is a level of flexibility in the US in terms of diversity. I believe so. Where in the UK, I mean, the response is very, very slow, if there is response at all. Just wanted to mention on that.
Yeah, thank you for sharing. And what's even scarier, Brexit probably, exacerbated this. And you're a small island, so you don't have a lot of choices, right? We are a big island. And you raise the issue of diversity, and we can spend a whole seminar, a whole webinar talking about what's going on in the United States and how this issue has become politicized. But we're actually over time, and I'm surprised that everyone is still sticking around. So I'm very, very grateful.
Thank you. It was interesting.
And I hope you got value out of today. Again, I'll be sending the link to the recording and also to the presentation materials to everybody. And thank you again for showing up. So grateful to everyone that's here and everyone that registered. So Rebecca, anything you want to add?
No, thank you very much. It was a great session. And yeah, we will share the presentation and everything. And if you want to continue the discussion, please send us a message in LinkedIn. Thank you very much.
Thanks. Bye, everybody.
Bye-bye. Thank you.